How do you pick the right stocks in a market full of options? In this video, I'll show you how to simplify your choices, eliminate the bad stocks, and focus only on the winners. Just a few years ago, I felt completely lost in the stock market. I'd scroll through endless stock lists, overwhelmed and unsure where to start. Should I trust the latest headlines, follow hot tips, or was there a smarter way? Every decision felt like a gamble, and I made plenty of mistakes along the way. But those mistakes taught me valuable lessons. After a lot of trial, error, and learning, I developed a simple and reliable system to pick winning stocks, and I can't wait to share it with you. Let's start with the first and most important principle. Only invest when the market is in an uptrend. This rule can make or break your success in the stock market. Think about it. When the market is trending upward, the odds are in your favor because most stocks rise along with the overall market. But when the market is in a downtrend, even the best stocks can lose value, and you end up fighting against the tide. So, how do you know if the market is in an uptrend? The easiest way is to follow the major indices, the S&P 500, NASDAQ, Dow Jones, and NYSE. These indices represent the performance of the largest companies and the overall market health. When they're moving higher, that's a strong signal that the market is in an uptrend. You can track these indices on any stock trading platform, financial website, or even using simple apps. But knowing the trend isn't just about looking at the overall market. It's also about spotting strength in specific sectors. For example, if the NASDAQ is climbing, that often indicates that tech stocks are leading the way. If the Dow Jones is gaining momentum, industrial or blue chip stocks might be driving the rally. This gives you a clue about which areas of the market are worth your attention. Let's take a deeper look at how to confirm an uptrend. One reliable method is to use moving averages. If the S&P 500 is trading above its 50-day or 200-day moving average, that's a clear sign of upward momentum. Another tool you can use is relative strength indicators, RSI. If RSI values are consistently above 50 or 60, it suggests the market has positive momentum. But trends don't just exist in the indices. They also appear in individual stocks. This is where you start narrowing your focus. Identify the leading stocks within the strongest sectors. For instance, let's say energy stocks are leading the rally in the S&P 500. You might notice companies like Chevron or ExxonMobil consistently outperforming others in the same sector. These are the stocks you want to dig deeper into. If the market is not in an uptrend or there are no clear leaders, don't invest. Sometimes the best stock to own is no stock at all. Our aim is to eliminate all the bad choices so only good ones remain. But if you end up eliminating all options, that's okay too. We only want to be buying stocks that have the best chance of becoming great winners. So, don't be afraid to sit on cash or another asset if the situation calls for it. Here's another tip. Avoid the temptation to invest during periods of high volatility or uncertain market direction. When markets are choppy, it's harder to tell which way the trend is moving. Patience is key. Wait for clear signs of an uptrend before committing your money. Let's break this down into a quick example. Imagine the S&P 500 is rallying, led by technology and energy sectors. You analyze the top-performing tech stocks like Apple, Microsoft, or Nvidia and see that they're hitting new highs. At the same time, you notice energy leaders like Chevron and ExxonMobil also climbing. By focusing on these strong performers within an uptrend, you align yourself with the market's momentum rather than fighting against it. The takeaway is this: don't try to swim upstream. Investing in a downtrend is like driving into a storm. It's risky and unnecessary. By waiting for the market to trend upward, identifying the leaders, and riding that wave, you simplify the process and set yourself up for greater success. Remember, the trend is your friend, so always work with it, not against it. When it comes to picking the right stocks, one of the most important steps is eliminating the worst stocks. This is where we use fundamentals to narrow down our choices. The goal here isn't to find the perfect stock right away. It's to cut through the noise so only a few high-quality options remain. Let me show you how. First, start by looking at a stock's revenue growth. A company that consistently grows its revenue is a good sign of strong demand for its products or services. Look for steady year-over-year increases, especially in the most recent quarters. If a company's revenue has been flat or declining, it's a red flag. It's struggling to grow, and you can safely eliminate it. Next, check the earnings. It's not enough for a company to bring in money. It needs to be profitable. Look at metrics like earnings per share, EPS, and net income. Ideally, these numbers should show a positive trend. A company that can consistently grow its earnings demonstrates good management and financial health. If you see declining or negative earnings, you know it's time to cross that stock off your list. Another critical factor is the debt-to-equity ratio. This tells you how much debt a company is using to finance its operations compared to its own equity. A high debt-to-equity ratio can be risky, especially in uncertain markets or during rising interest rates. Look for companies with manageable debt levels. This reduces the chances of financial trouble and improves stability. Now let's talk about competitive advantage. This is what sets a company apart from its competitors. Does it have a unique product, a strong brand, or a dominant position in its industry? Companies with a competitive edge are more likely to perform well in the long term. For example, a tech company with patented technology or a retailer with a loyal customer base is worth keeping on your list. If a company doesn't stand out in its industry, it's probably not worth your time. It's also important to look at a stock's valuation metrics, like the price-to-earnings ratio. A high P/E ratio might suggest the stock is overvalued, while a low P/E ratio could indicate it's undervalued. But don't just rely on the numbers. Compare the P/E ratio to others in the same sector. If it's significantly higher or lower, dig deeper to understand why. Here's an example to put this into perspective. Imagine you're looking at two companies in the same industry. The first company has consistent revenue growth, a reasonable debt-to-equity ratio, and a competitive advantage. The second company has stagnant growth and higher debt levels. By using these criteria, you can eliminate the second company and focus on the first one. This process simplifies your choices and ensures you're left with only the best options. Finally, remember that no single metric tells the whole story. You need to look at the complete picture. If a company performs well across several fundamental indicators, it's a good candidate to keep on your list. But if it fails in multiple areas, it's better to move on. The beauty of this approach is that it saves you time and reduces decision fatigue. Instead of trying to analyze every stock in the market, you can systematically filter out the weaker ones and zero in on the strongest candidates. This way, when the time comes to invest, you're already working with a short list of high-quality stocks. Now that you've identified strong stocks and invested, the work isn't over. Even the best stocks don't stay strong forever, and that's why staying alert is so important. A stock that's performing well today might weaken tomorrow, and holding onto it too long could cost you. Let's talk about how to monitor your investments and know when it's time to sell. The first thing to remember is that the market is constantly changing. Companies face new challenges, industries cycle in and out of favor, and the broader economy can shift direction. That's why it's essential to keep a close eye on your stocks even after you've bought them. One way to do this is by setting regular check-ins, weekly or even daily, depending on how active you are as an investor. Start by tracking the stock's price action. Look for signs of weakness, like a stock falling below key levels such as its 50-day or 200-day moving average. These levels often act as support, and when a stock drops below them, it can signal that momentum is shifting. You don't want to hold on to a stock that's breaking down while the rest of the market or its sector is moving up. Next, pay attention to changes in fundamental performance. For instance, has the company reported a bad quarter? Is revenue slowing down? Or are earnings starting to decline? These are early warning signs that the company may not perform as well in the future. Even a strong company can face setbacks, and it's your job to act before those problems erode your gains. Another key factor is the stock's relative strength. Is the stock still outperforming others in its sector or the market as a whole? If it's starting to lag behind, it could mean that investors are losing confidence. Compare your stock's performance to the major indices and its peers. If it's consistently underperforming, it might be time to consider selling. It's also important to stay alert to external factors. Market news, economic changes, or unexpected events can impact your stocks. For example, if a stock you own is in the tech sector and the Nasdaq starts showing weakness, that could be a signal to reevaluate your position. Staying informed about what's happening in the market helps you make better decisions. One useful tool for managing your investments is setting a stop-loss order. This is a preset price at which you'll automatically sell your stock if it falls too much. For instance, if you set a stop-loss at 8% below your purchase price, you limit your downside while locking in most of your profits if the stock turns against you. But staying alert isn't just about watching for weakness. It's also about knowing when to take profits. If your stock has gone up significantly and reached your target price, don't be afraid to sell and lock in your gains. You can always reinvest in other opportunities. Let's look at an example. Imagine you bought a tech stock that's been performing well for months, but suddenly it starts to decline. You notice that its price drops below the 50-day moving average, and at the same time, the company reports lower than expected earnings. On top of that, the Nasdaq begins to weaken. These are clear signs that the stock strength is fading, and it's a good time to sell before losses stack up. The key takeaway is this: investing doesn't end once you've picked a stock. You need to stay vigilant and be ready to act when the stock no longer meets your criteria. By staying alert, monitoring performance, and having an exit plan, you can protect your gains and avoid unnecessary losses. Remember, it's better to sell too early than too late. Profits in hand are better than potential gains that never materialize. Now you've learned how to simplify stock picking by focusing on the best and eliminating the rest. But what if you're starting small and don't have much money to invest? Don't worry about it. Check out my video on how to invest in stocks with little money, where I share practical strategies to start building your portfolio, even on a tight budget. Click here to watch it now, or check out some of my other videos. And before you go, make sure to subscribe so you never miss out on tips and strategies to grow your trading skills. Thanks for watching, and I'll see you in the next one.